What's up, Gould Miners? In today's episode, we welcome Sal Buscemi, an investment advisor to the ultra wealthy. Sal runs both a private equity firm as well as a family office. And in today's episode, he shares the investing secrets of the ultra wealthy. We go deep into the tactics on how someone like yourself can elevate their network and start getting access to better deals. He also goes over how he makes investing decisions and how anyone can take that same discerning lens that the ultra wealthy use to look and inspect at their own investing decisions and their own investing strategies. Sal is a renowned author and a true investing expert across a myriad of asset classes, and it really is a privilege to be able to sit down with him today. So without further ado, everyone, welcome to the show, Sal Buscemi. Sal.
Yes.
Welcome to the Gould Mine.
Thank you for having me. It's a pleasure and a privilege.
Well, you know, I've watched you online now for a couple of months, and I've been, you know, carefully observing, and I know that you and I share a similar path. We were both pre-med,
yes,
and then very much on the medical path, and then all of a sudden,
yes,
boom, hard left, right?
Yep.
So, what inspired you to make that pivot and change career trajectories?
It's interesting. It was visceral. There's a couple of things that was happening at the time, and I'll tell you, it was the summer before my senior year, and one of my father's friends gave me a book that was written in 1977, and here I am reading it in the late 90s, and the name of it was Confessions of a Medical Heretic, and it was I can't remember the author, but it's still available on Amazon because I bought a copy for a friend who was thinking also of going to medical school, and it was. At the time, it seemed like that was the ultimate sophistication. And what happened was, to be honest with you, Danny, is that during my internship, I actually passed out holding a fibula in the cadaver room at Beth Israel Hospital in New York City, which is now since converted to condos. And at that point, I realized that maybe this isn't really the profession for me, and I might have to pivot. And that, of course, back in those days, we graduated in 4 years. Kids today graduate in 7, 5, 10. So, undergraduate, right? So I crushed 24 credits my senior year, first semester, and then 22, afterwards. And I got to tell you, it was kind of hard because I was going along with the punches, and I'm thinking to myself, gosh, I don't want to wind up in a master's program or a PhD program. So I do write about it in my book, which I'm going to give a free copy to your listeners too on Audible a little later at the end of this. I'll tell them how they can.
It's awesome.
But it was really what came to it was the networking, and it was very fortuitous because of the fact that this doctor that I worked out for before my head hit the cold floor in the hospital in the cadaver room, I was championing him. I mean, I would do anything. I put him on a pedestal. He had a beautiful wife, Josephine Aston Martin, lived in the same building where Gloria Vanderbilt is on the Upper East Side, way over where, Gracie Mansion is. And actually, I moved there shortly after college because I love that area so much. And it reminded me of just, good times over there. However, the problems were that I did not want to do this. And he and I had a very frank conversation after I spoke. And he said, look, I just want to tell you, my brother just made partner at Goldman Sachs. I told him about all the great work you've done for me. I think you have great character. I didn't even know what the hell this was at this point. And I said, okay, great. I'll do that. So that became a different life lesson. And really the biggest life lesson was that, and it's mentioned in the book, is that, a doctor can put up a shingle on Park Avenue and clients come in. But when you're selling ideas as an investment banker, advising on, any sort of financial transactions in high finance, it's more sales. And that's what a lot of people really understand. So it was interesting, to get that standpoint and that context from him, and it really sort of set the table of, other things as it relates to, later on managing money professionally for some of the world's top families.
So that was Gould. That was chapter one, right? Kind of getting into investment banking, Goldman Sachs. You now run a family office. So what were the steps in that journey?
Oh, of course. So I went through some personal issues. I lost my father when I was working at Goldman Sachs at the age of 24. And I promised to myself, and he was 56 at the time. And I'm like, wow, that's young. It was a heart attack. And So I made a promise to myself that I would go, what anybody does on Wall Street, they eventually, if they're worth their own salt or try to, they raise an institutional fund. And so I said, I'm going to start my own fund by the time I'm 30. And that's exactly what I did at the age of 29. It was fortuitously timed, to be honest with you, Danny, because what had happened was the advent of the great financial crisis of 2007-8. And we basically raised money to buy the kitchen sink from Bear Stearns, buying the whole loans, not the synthetics, not the stuff that you saw in the movie with, The Big Short, just the whole loans. And this was collateralized by some rough product in middle America to luxury homes in Las Vegas and Southern California to even apartment buildings. And it was great because, I had the skill set to be able to do that. And, at the beginning, when you're getting into this, it's like you're being tested, if that makes sense, because 29 is young. I mean, it's young. And looking back now, we've seeded some first-time founders who are mature beyond their years, and that's exactly what we want. When we've done that, we've had success with one of them actually being the youngest team to get FDA approval for their device for artificial defibrillation. But really what it comes down to everything is that it was the track record I had with that. And then another fund that we started, I actually moved out to Las Vegas. I was following one of the, legends on Wall Street, Steve Mnuchin. He had bought IndyMac in Irvine. Irvine was the alpha and omega for all excess during this time. That's where we got the Real Housewives of Orange County because of the conspicuous consumption and everything. That was during the time when these mortgage brokers and realtors were making a lot of money. And of course that backfired when people just couldn't sit and refinance their homes every 6 months. So, because of my background in real estate and mostly being on the distressed or value side, not like value added side, I raised a lot of money to insulate some investors into things into, what's called, broadline retailers, sort of like a CVS, if that makes sense, but, in middle America. And I was outbid on this and I wound up having to get a lot of money back. And a lot of the families that I had been investing with, on these independent, like syndication type of deals, they said, what are you going to do now? And I said, well, in New York, one of the families that supported me is a life science family. He's very, very well known, very well connected, has had multiple exits. And he said, why don't you turn your guns on me? And it was interesting because a lot of the real estate families all had gateway to life sciences through philanthropy, right? Poorly managed philanthropy, very expensive. I mean, these are like, people making like as much, running these these foundations sometimes as like, Wall Street bankers or CEOs, right? And so, it's not always an alignment of interest with the benefactor and the, and the philanthropy. So when we showed these investors that they could invest 100 cents on the dollar to the, directly with their discretion into these world-class companies, it became, an enlightening point to them because now they could say, okay, well, this is great. I'm getting involved in something else. I'm able to build a legacy. I'm able to, more importantly, join Sal's community of like-minded, families who are doing the same thing. And that's really what I think a lot of people are looking for today with the families is the interactivity. And it's probably a very long way of answering your question, but, it started out with me seeding a few deals that did really, really well. And then starting a smaller balanced venture fund. And then after that, moving into HRN, which is with my two partners, both of which have very strong pedigree experience in life sciences. At 26, my partner, Albert Ewan, was managing $6 billion in life sciences for the Rockefeller family. And he did that for a decade. My other partner, Bill Workmister, at the age of 26, was head of life science investing for the Texas State Pension program. So you're dealing with very high caliber people with a very high caliber network where we're able to get into these opportunities. And, the saying I use is mice go where elephants can't. And sometimes, we don't lead these investments, but, if they're started by rock stars, we've had multiple exits in there. They have a cap table, which I consider to be the soul of the asset, which is other in-kind lead families, then that's definitely something and someone who I want to work with. So, we've built our family office around that and it's worked out very well so far.
Yeah, that's awesome. And it sounds like a very organic growth into that. So it wasn't like, one day we're just all deciding to like start this family office. It sounds like there were several steps, syndications first, and then eventually gradually growing into that. By the way, For anyone who's listening at home right now that is unaware of like what there are many people still that don't know what this is. So could you give like a very brief description of what a family office is and the objectives of a family office?
Yeah. So family office is a term that's been abused now, just like hedge fund was during the 2000s. And a lot of it is used by people who are RIAs and what we call, sell side people and drag trying to sell stuff. And the family office is the opposite. It's the buy side. Okay. And to me, you have to have and this is just, Wall Street parlance, you have to have a minimum of $100 million in investable assets. Okay. That's not including your house, but investable assets. And because it costs money to run and manage these investments. And these families don't necessarily put all their money into stocks like Warren Buffett. They put them into privately held opportunities, what we call direct investments, because it gives them some level of control, discernment, and it's actually, to them, it's much more safer because they can negotiate the terms and control the deal. We like it because, there's real value there, and it allows us to, get ahead of the curve and invest in things that are not public, that are not going to be abused, because the public equities market is just, to me, it's very difficult to really turn a dollar that day, these days, doing that. If you're running like some sort of a fund or something, the risk, I think, is just a little too high right now. And with the advent of some of the other opportunities that have come, we put together a specialized structure so that our investors can invest into these opportunities at their discretion. And it's great because it doesn't allow me to have the risk of having what we call an IRR clock to my head, which means, once you take on someone's money, you have to get it out there and get it working. If it's just sitting in treasuries or cash equivalents, you're not doing anyone any favors, and you're definitely not building a track record for yourself. So we structure it more like a call fund with agreements with the families. And, some of the things that we've been able to do was we got into SpaceX in August because of, the success we had on other opportunities, but we were able to move fast with that. And I think if other people had like a fund structure or other types of structures, they probably wouldn't really have been able to move that fast. But we were able to do that because we were, when we were putting this together legally and structurally with Perkins Coie, we wanted to make sure that this was built for speed and discretion.
So someone listening at home right now that isn't ultra wealthy, and, statistically speaking, that's most people that are listening to this call right now or listening to this podcast. We're going to really go in depth here in a little bit into some investing strategies and everything like that. So for those that are listening that don't fall into the category of ultra wealthy, can't use your services, why should they listen to you? I
think that there's correlations between what we're investing into and what they can invest into at a smaller dollar amount. And I'm prepared to, share those strategies. I think when it comes to multifamily syndications, I've been very vocal on certain aspects of it. And it really comes down to the function of your network, right? You're only going to see opportunities as a function of your network. And if you're a dentist or you're a lawyer or you're an airline pilot, you're not seeing anything that's outside of your network from, a guy like me who sees the stuff all day. It's just not part of your job. So by the time you see it, it might be good. It probably isn't good, as at least having, quality. And so that's what it is really, sussing out your network to make sure that you're able to see these opportunities the way they are. Everybody's got a stock tip. And, it was interesting because during the whole pandemic, a lot of people were just, it became very transactional with people pitching Bitcoin and a lot of fast money and everything like that. But if you're a founder or you're looking to raise money or looking to syndicate money for yourself into opportunities, I would say, I would follow, when it comes to real estate, Danny, I would follow these 3 rules, and this will help you a lot. And I can tell you, when the next great financial, recession comes, whenever it is, you're going to come out looking clean. And that is that you want to pick sponsors. You don't want to do it yourself. You want to pick sponsors who you can raise money around, who have the 3 rules that I'm about to tell you. Number 1, I want them to have a strong track record, meaning I want them to have been through at least 2 cycles, Danny. 2008 was one. This one hasn't really started yet. There hasn't really, that's going to, we'll see the pain of this within the next 12 months. But I want them going back to when I started in like the mid 90s. Okay. Because these are the guys that have the, the intestinal fortitude, the value system, and the ethics proven to be able to get themselves out of problems. Whether that's negotiating with lenders, there's more to this business than operating a spreadsheet. And I think a lot of people get that wrong. Number two is I want to see that they have audited financials. If their track record's so good, pay to have them audited. Honestly, it should be like your Super Bowl ring. You should be minting it for yourself if you do have that success. And the fact that you're not doing that, is going to, some investors won't ask the hard questions, but in order for you to level up, guys, you're going to ask for the hard questions. But that insulates you as an investor. And then third, I want to see a strong sponsor co-invest, a strong co-invest, skin in the game. 5% is cute, 10% is thoughtful. Anything more, Danny, provides conviction. And that's, some of the deals we do, one family will put in 50% and HRN will come in with the other 50%. And, that's just an idea of how we structure these. We're equity investors, but that's how we play the game to insulate ourselves from risk, especially in real estate.
It makes a lot of sense. And so there's actually quite a bit to unpack there. Let's go back before we go into what you just said. Let's go back a little bit. You talked about the physician and the attorney that, by the time they see the deals, they're probably not that great of a deal, right? So how does one level up their network? Because obviously, like there's a variety. There's like tiers to this, right? But like investing in SpaceX might not be a practical or even possibility for most people. But like, for example, real estate deals. Mm-hmm. How would one level up their network to the point where they are getting access to great real estate deals?
You got to take your network seriously. In order to do that, you got to invest in it. And not every, a lot of people like to do things for free, especially when they're starting out. But the problem is that anything you do in life that is a low barrier to entry usually attracts similar people who, are low barrier to entry or, not necessarily the people who you might want to invest in for the first time. So I put a big emphasis on just going to industry conferences. If I'm in real estate and I'm looking to do multifamily syndication, I'm going to pay to go to an event somewhere, wherever it is, to go to that conference to meet the real people to qualify them the way that I just told you how we did this. You can also find other investors there. But there's a pay-to-play element here that a lot of people are very reticent to use because they're like, well, I don't have that much money to do or anything like that. Just go out and meet people outside of your profession who are doing these syndications, who are doing these types of real estate deals at these industry conferences. IMN is one of them. I speak at a lot of those. And then there's also family office conferences too. IVFON, IVYFON.com is another one for family offices. And you're really now sort of around the people who have a lot more experience than you because they've been doing this for so long. Whereas if you're not in the profession, the only thing you're hearing, and I see this with doctors all the time, is, one guy is a great anesthesiologist and people respect him, but then he starts getting into Bitcoin and people start following his trades. It's not it's not really commensurate with the skill set. And then, but everybody has that need. And I think you have to fight the need to get rich quick. I think the biggest thing you could do really, if you were to look at, wanting to get into this, how you would add value in the most discerning way is to build your network. And if you build your network with quality people and even using LinkedIn, because everybody uses LinkedIn. If you're not using LinkedIn, you're weird, in this business. Nobody's going to show you anything because nobody knows anything about you. If they don't know anything about you, even as an investor, why would they trust you, right? So, I mean, when we onboard a family, there's usually a warm introduction, but then I ask a battery of questions because I want to make sure I know who I'm dealing with. So, tell people, and the best way also to get into it, if you can, is to write a check. Just write a check to a deal so you can learn, because you will never pay more attention to an opportunity than when you write a check, because then you're going to see how everything happens. It's going to be a learning process. As the Bible says, your heart is where your treasure is, right? So this is where, you get to really learn by taking a front seat. You can learn a lot more by writing a check for $50,000 than you can going to, a fancy business school about this business by, learning like why the sponsor is valuing it this way, where's the financing coming from, and just asking the questions, asking to follow along.
That's awesome. So and I think that anyone listening right now, that you should probably go back and rewind and play that again. The main takeaway for me there is like you have to surround yourself with the right people that are going to put you in a situation to be able to get access to those kinds of deals, which makes sense in theory, right? But then in actuality, like in the real world, like how do you do that? So yeah, networking conferences. I mean, yeah, and honestly, like I can tell you, the majority of the contacts that I have made in the hotel world have come via either LinkedIn or conferences.
Yeah,
that's it. So you just named like the two that I have personally. So what you're saying is 100% true, and I would concur with everything that you just said. Let's switch gears a little bit though, because I want to come back to the 2 cycles rule.
Mm-hmm.
Okay, so I guarantee you, and myself included, actually. So as I'm saying this, it's like this is a selfish rebuttal here too.
Okay,
but I guarantee you, there are some people that are listening to this right now who are fledgling sponsors who have not gone through 2 cycles. So, and you yourself, right? You started your first fund at 29. Now, obviously, you had like an investment banking background, so you had maybe like osmosis some of that knowledge through your peers, right, at Goldman. But what would you say to a fledgling sponsor that hasn't gone through those 2 cycles, and what could they do to help accelerate that? And or what would your advice be to someone that hasn't really gone through that wants to get into that game?
I'm going to say it. Nobody's going to listen, but I'll tell you what it is. All right. When you're raising money, it's the highest order of sales in the land. And if you're a fledgling sponsor and you're just starting out, you should probably be raising money around other people's deals who are much more experienced than you are. Everybody needs capital. The second rule of real estate that all these guys figure out way too late in the cycle is always be raising capital, right? The first one's, of course, location. Second one is always be raising capital. And if you can put together systems so that you can build a network of investors to invest into properties that you probably would never be able to get into on your own unless you were able to scramble, $1 million or 2 together, then you're going to be able to start out with a track record where you'll be sleeping better at night. The problem is that I've seen this happen before. There's a pride of ownership and an ego that goes with this, and especially with, newer people, people with a quantitative background, they think it's all numbers, and as long as, it models out on the spreadsheet, then everything will be okay. No, it's more than that. You're dealing with all sorts of issues like banks and investors and that. And if you can go out there and really be a salesman and really learn how to sell, to be able to build sort of a network of investors, to place that capital at your discretion into things, that's the most powerful role you can have starting out.
Makes a lot of sense. And actually, I
don't look for deals. Everybody's got a deal. Nobody wants that. You need to, the highest value you can provide is being able to raise capital for these other sponsors.
And truthfully, I have found that to be the case. Like there's the 2 things. Well, the hardest thing, it seems like, is raising the capital. The second hardest thing is finding the great deals, like the really, really good deals.
Well, I think it's easier to raise the capital, really. I think
than finding the great deals.
Absolutely. Yeah. Let someone else find the great deals and you attach your resume to that.
Yeah, makes sense. Well, that actually reminds me of, and I'm sure that you've read this book, Pitch Anything, by Oren Klaff.
Oh yeah.
Yeah. And when he, and having been in residential I was in residential for 9 years. And I read that book really early on in my sales journey, in my sales career. And it changed everything for me because really it opened up my eyes to, how to really pitch or sell something. But not only that, it also opened up my eyes to this like whole new world of finance and raising capital. And that was really the first time that I had an introduction to that. And one of the things that stood out to me was, I had always heard the commercial guys saying, because the commercial guys love to talk, and they say, oh yeah, commercial is all about the numbers and yada, yada, yada. But Oren says in the book, it's like, hey, even the savviest investors, they tend to make investing decisions based on the like more emotional side of the brain, and not necessarily he calls it the croc brain, right? So the croc brain.
Oh yeah.
In your experience, Sal, because you've dealt with ultra high net worth individuals, and in your experience, like are you seeing that in real life where there's a heavy emotional component to decision making even at that level?
Yeah, and I'll tell you what it is that everybody regardless has the dopamine in their system. It's just expressed differently, right? And the way that a lot of people like to see this, especially depending on where they are, like a first gen or second gen, they tend to express their status differently, all right? Like in my book, I talk about how the mogul, gets the flashy Rolls Royce. He's the first gen, he hasn't really matured yet. He got the Breitling watch, with bedazzled diamonds around it. So what we do is we put an emotional component to all of our deals, okay? And we do that by providing them with opportunities that will motivate them to take action. A year ago, we invested in a company called AI Scout. And we're actually doing a follow-on of it right now. And that is a AI company that is used principally for recruiting for now soccer and soon American football, cricket, and a few other sports I can't think of right now offhand. However, one of the things we needed to do is we had to talk to our investors during the month of August. And during the month of August, nobody wants to pick up the phone. And it was kind of difficult to sort of put together the flow of how this would work and how we would be able to get meaningful interest. So at the time, fortunately, one of the investors into AI Scout is the owner of Chelsea Football Club, who bought it from Abramovich during the time when we were making the investment, and he had just closed the sale. And I called the CEO and I said to him, look, I got to get these people's attention, and I have an idea to do this. And I said, if you can get me for each investor a personalized Chelsea Football Club autographed by the entire team, I think we'll be able to get this thing oversubscribed. And he said, sure. Sure, Sal. And sure enough, I can tell you that, and I mean this sincerely, these are very sophisticated investors. The minimum investment for this was $100,000. The subscriptions came in so fast. It was incredible. And the reason is because they just wanted, they knew it was a great investment and everything, but the emotional part that they're able to show this off to someone in their living room, and they live in, for example, St. George, Utah, is quite prestigious, right? It's a conversation piece at Thanksgiving. People come in and say, it's behind glass, like you would see at any other like sports memorabilia shop. And people ask questions. How do you know? And so it's perceived to them, and this is the emotional component for you, Danny, being smarter, more sophisticated, better connected, and hence more attractive than your peers because of this. Does that make sense? So we actually we're doing this actually with a company that we've already invested into with a co-founder who's a 2018 Nobel Prize laureate. And I said to the families, if you invest $1 million, not a donation, this is an investment, a hard investment, principal direct investment of $1 million, you can have lunch with you and your family with Dr. James Allison down in Austin. That idea went over very, very well. And, we were able to get subscribed on that. And the reason is because people want to be able to take Instagram photos to show around the holidays, this is what we did this year. We did something impressive. You didn't do anything as impressive as meeting a 2018 Nobel Prize winner. And wouldn't you like to know the story behind this?
That's a fascinating take on fundraising. So it's almost like attaching a prize or attaching a some sort of like like when you're, what's the word I'm looking for? I'm like searching for the word, but it's not. Something
called a
that
premium.
Yes, premium.
Yep.
It's an incentive. That's a really interesting take, and it's simple enough. But the prestige, it adds to the prestige of the investment, which is really interesting.
This world, really Charlie Munger says this world isn't run by greed, it's run by envy.
On on that same note, what you've probably, so that's actually a really interesting premium story. What is the most surprising emotional trigger, premium, whatever, that prompted an investor to invest or commit to a real estate deal or any deal, really?
I think that is the jersey's one of them. That's for certain. The other one that we do, and we're doing this with a company called Thrive Bioscience, is that you always want to give a premium. And this is a company that its founder I've become good friends with. We sort of started an informal book club between he, myself, and my partner. And the company's name is called Thrive Bioscience. So what we're doing is we have fleece vests going out to all of our investors at Thrive Bioscience. This will be the CEO's 15th exit and 8th unicorn if he knows what he's doing. And so, people want to wear that. It's a conversation piece, especially if you're an anesthesiologist in LA. You wear that into the office, people are going to say, ooh, what is this? What did you invest in? So now you have an understanding and a story that matches the pedigree and why we invest in founders that are not first-time founders.
That's a really interesting take. So it sounds to me you've got the family office, but you're also so you've got two separate ventures. Am I correct?
Yeah, that's correct.
You've got the family office, and then you've got like a private equity fund or something.
My own investment platform. Yeah, called Dancher Partners, and that's mostly real estate. And HRN is not real estate, mostly life sciences and tech, but I also have two partners in that too as well. And, it's because of them that we have the success that we've had in these ventures.
How do you find great partners for someone that's looking to partner up like that? How did you do it?
You have to find someone that complements your skills. What you don't want, and I think what you don't want is your friend who's a CPA to be your partner, because that person is never going to take risk. And it's just going to cause a rift. It's true. I see there's certain stereotypes persist, and, accountants, or board, of course they want some action, but they don't like the risk. Right. And that's the same for management consultants too, as well. But you got to find someone who complements your skill set in a yin and yang type of way. I'm very good at real estate is my, main, core discipline. However, that's not to say that I found two partners that have the same background as I do, but they're in venture, and that works really well. But I'm very good at like the sales, what we call the coverage banking, staying on top of this and being on top of the investors, because you need to do that. This is a more interactive than, putting your money with Franklin Templeton, for example, and you have to report to people. So the CEO is naturally the IR person. And that's me. But as far as the diligence is concerned, as far as the, some of the fund administrative stuff that we have to deal with, I have partners who are very good at that stuff and they understand it. But it's also like what the expectations are as it relates to that relationship. And I think what you want is, especially if you're finding a partner, is someone who's going to roll up their sleeves. And when I was working at Goldman, they had a saying, it says, you never want to let your partner down. That's sort of a definition of partnership. So, we've all gone through things. I have one partner that's going through a traumatic divorce right now. But that's not to say that we don't include them in things and everything. It just knows that we had to pick up the slack for a little bit through this process. And, a lot of people would get very upset about it, and you need to really bury your ego. At the end of the day, you really need to bury your ego. Be very careful when people, talk a big game about how great they are, because especially if anybody sees any sort of modicum of success that you're able to show, you're going to start getting people, glomming onto you, so to speak, saying, hey, I would love to work with you. But you got to ask them, what skill sets do they have? And are those the people who you ever want talking to an investor when you're not around? Will an investor trust them as much as they do you? And if the answer is no, get rid of them. Keep them as a drinking buddy, but you don't need them as a partner.
Wow. That is a phenomenal lens to look at things at. It's like, hey, if you weren't around and they're talking to an investor, would you trust them? That is, jot that one down, anyone who's a sponsor or thinking about doing it. But that's a good one. That's a really, really good one. Speaking of risks, how would you educate investors about risks associated with, any sort of deal without scaring them away?
I have rules. And if you go outside the rules, what happens, right? It's like skiing, right? When you're skiing down a slope of course it's going to, there's fresh powder here and you want to go through the ropes. And if you're in Europe, they don't care if you died. But in America, you have to stay within the lines. So if you go outside the lines, you take higher risk. The way we've diffused risk, and it's a function of the network, and the network is a function of the people who trust you, is you need to look at each opportunity as if you're investing into the person. And when you're doing diligence, it's not just so much like going through and trying to figure out the market opportunity. It's, do you really trust this person with your wallet? And I'll tell you the two rules we look for when we invest in anything that's venture related as a direct investment. Number one, I want a founder who has had multiple exits. In the case of Tom Forrest Farr Porsche, he's had 15 exits. This will be his 8th unicorn. Thrive Bioscience, and investors get, a lot more than a free vest, right? Second, I want to make sure that they're led by an in-kind family office. Remember, a real family office with a name, not a cousin who, has like who sold his dental practice for $5 million. That's just a rich guy. Actually, it's a middle-class guy today. That's a whole different story. But that's just a guy with some money in his pocket. That doesn't necessarily mean that he understands the intricacies of a life science company or the patents involved with it. Using Thrive Bioscience, for example, the lead investors on that are large families you would know, but they're both in kind because they have either created their wealth or have supported through their family offices other companies as such because they know that discipline well, one of which happens to be one of the top IP families in the country. You wouldn't know this, but it's the Parker brother family, right? And they were very interested in this company's IP. So, these are the types of people that you want. I would say that, just putting this together and buttoning it together for you, I would say, if you're investing in something, find out who the other investors are. The cap table is really the soul of the asset. And if you have a bunch of $25,000 bundles there, or maybe 100, that's not really a good investment. That's people who are like investing in someone. They're not investing in the idea. I mean, we all invest in someone, but it's a side of like not having sophisticated investors that the idea is probably not something that is not attractive to them at this point. Not saying it won't, but I like saying that. And if you can really, and I was actually going to write a LinkedIn post on this as well, but I had a friend who went to several startups and he was asking, and he went to 3 of them and they failed. And he said, why, how come I go to these startups? I think I'm going to get options and I'm going to get rich. And I'm like, well, if you'd listened to me and qualified these companies before, taking, and he has a family, I don't. I said, you probably would have avoided this. And I said, number one, all of your founders have been first-time founders, okay? And, first-time founders are younger and sometimes they have huge egos because they haven't been humanized yet, if that makes sense. And second, not one of these companies had lead investors. They were dependent on someone's uncle or someone being a benefactor, paying these people so that they could do this. And that's where they ran into the cash flow issues. And of course, if you don't have someone who comes from the same background as you do, you don't have a strong enough culture to understand this, to really, to weather it. And that's where the friction comes in. But you should really look at these companies, the same way as if you were going to work for them or invest in them. Is that, don't be scared away. Just ask who the sophisticated investors are. I think Shark Tank has done this country a disservice by just saying anyone and consumer discretionaries can come out with an idea, a new pen, whatever, you can write with it upside down. However, it's not necessarily going to be $1 million deal overnight. We all know a lot of those deals fail anyway, because you're dealing with first-time founders who are desperate, right? And that's never a good thing. But we like to also, and another rule is we like to invest in higher barrier to entry businesses, right? If somebody's making a pen that can be knocked off by a kid in a garage or somewhere in China, how good is that product, right? I mean, IP and all that stuff aside, it's a low barrier to entry industry to get into. I'd rather be in like life sciences and AI, well-qualified AI, that is, and other circumstances where you're crowding more sophisticated investors.
How would your lens translate? So that's the lens that you're looking at businesses at, which is awesome. How would you shift that into identifying potential real estate deals, and what are the criteria, or what are you looking at in the deal? Are you just relying on the track record of the sponsor, right? And you're more investing into I trust these individuals, or are you actually taking, or your company, your family office, taking the deal apart? You're underwriting it yourselves.
Oh yeah, we're still underwriting it. Yeah, I mean, we're still underwrite it and everything, but it's gotten to the point where I know what I'm looking for, right? And so I know exactly what I want. I know exactly what it looks like. And it could be like compared to anyone who's looking for a particular classic car, right? On eBay, right? You know what you're looking for. I have a lot of friends that have Porsches. I'm not a Porsche fan. I mean, I'm not a car fan really, but they know what they're looking for. They can get into like the details of it. And I love industrial and logistics. That's what I like. And that's what we've been successful with. There's a higher barrier to entry. So I'm not looking at multifamily. I'm not looking at anything because the families that I have, they're more sophisticated and they don't want tenants who are poorer than they are. And that's why, we saw a lot of issues come out during the pandemic, especially in some cities like New York, where there's been rent abatements and people, were having a hard time and mortgages were not being, payments weren't being made. And it sort of reversed the context of, sort of like the fabric of, of society where, the tenant was in control and everything. So a lot of people lost a lot of money and they don't like multifamily. That's just my families. That's not everybody. There's a lot of people out there who like that stuff. The second thing is that, I want to work with, now that I got the asset class out of the way, I get that. I only want to work with people who have done this for a while. Okay. How long have you been doing this for? We're working with a family in New York in January. They've been doing this for as long as I want them to, going way back to the 90s, actually, since the late 80s. And they own 8.5 million square feet of industrial and logistics. So I like that. Now I understand that. Okay. So that's great. Number two is I want to see that they have an audited track record. Most of these guys, if you own 8.5 million square feet of anything, you're going to have an audit. Okay. It just happens that way. So that's good to do. And, as part of the, the process. And then I like to hear that first, that they have a strong co-invest. What are they putting into it? How are we participating? And then at that point, I'll go into the numbers and start playing with the spreadsheets. Because at that point, it's just assumption. It's like, do your notes and, does your math homework match with mine? Here's where I found some issues as it relates to, maybe an exit cap rate or something. But it's never really more difficult than that. But you have to understand, I also look at less deals because I'm very particular on what I'm looking at right now. Anything else other than that would be, and that's just an example of what we're working on coming into the new year. But there are also going to be some statement Class A assets that we might want to get into that might not make sense right now, but, perhaps in like a different location where, for example, office isn't as nearly hit, as other areas of the United States. There could be an attractive opportunity there. Maybe with, and I'm not saying all multifamily is bad, but like maybe with a statement class asset in New York City where it's Class A and, the rents are everything is stabilized. That's something we might want to get into. Remember, we don't want to bet on anything good happening. We already want it happening and performing most of the time when we get in there. And, there'll be times where there's special situations where, there'll be some development deal or something that you just can't walk away from and you'll probably, cancel a vacation for. And, we're prepared to do that too as well. And that's usually set up as a standalone equity facility.
Well, you're looking at deals right now in 2023. Obviously, the debt market is a massive concern right now. So what are you doing right now to hedge against what is likely going to be a lot of blood in the streets over the next 12 to 18 months?
We've been sharpening our axe for this for the past 2 years, actually since the pandemic, because that's really when I think, this is the elasticity right now was going to swing the other way. And for me, the inflection point, which has nothing to do with real estate, but before I moved to Miami, I was at Art Basel following the pandemic. And the amount of NFT money around and Bitcoin money around, sloshing around in suitcases, told me this is like the end, sort of like the internet, back during 2001. The inflection point for that might have been like AOL Time Warner. So getting back to your question, as it relates to, we're looking more, there's a lot of ways we're participating on this, but I think it comes down to maybe putting together debt facilities, private credit. That's something with, that's an old standby where if the banks aren't lending or whatever, you can have a couple families syndicate a loan to be able to provide to, a very good operator to be able to, take advantage of that. The debt funds are popular right now if you know what you're doing. I wrote a book on it called Making the Yield about 10 years ago, and it's an industry classic, actually. If people want a free copy of it, they can go to makingtheyield.com. There's an Audible copy they can download for free. And one of the things with that is, equity is risk, debt isn't. And so if the banks aren't providing debt because they are afraid, it's usually not because they don't want to. It's just that they're restrained to because their current balance sheets don't allow them to do that. The families will step in, and there's plenty of private credit out there to take care of a lot of good deals. There's not an issue right there. And you hear of all these big funds doing it. It's not really our business. We're more equity allocators. That's not just, we won't do some sort of a debt facility later on. But, if you have contacts in the industry, and again, we're not operators, we're just equity, we're just allocators straight. There's plenty of funds that you can call. Apollo's got one, Carlyle's got one. I mean, there's a lot of these funds out there, private credit funds, that have already raised all the powder, the dry powder for you. It's just a matter of networking into those places.
Yeah, that's awesome. And actually, you're the third person this week. And, debt funds, I'm obviously familiar with them, but you're the third person this week that's mentioned that.
Yeah.
3 separate conversations. So it's interesting. Making the Yield is one of your books. You also have your latest book, which
Investing
I believe,
Legacy, right here. Yes, right here.
So what are some insights on how, you talk about investing legacy, what are some key insights from that book?
2 things. Number 1 is that if you're dealing with families, you're in a much more relational business. It's not transactional. They want to build relationships. The overall arching thesis behind this is centered around the value of your network. There's a person I profile, a family office we did a deal with in New York City. Before the pandemic, he averaged 220 days on the road around the world. More than a diplomat. However, that's the price he pays for having a strong international network and being able to have power and persuasion.
Well, Sal, we're coming up on time here, so want to be respectful of that. In traditional Gould Mine fashion, I ask that you share with the audience one final gold nugget for them to walk away with.
People always ask me, what is the definition of a brand? I will tell you what I've learned is that everybody has to have an individual brand today, but a brand is not a logo. It's not something you pay 40 grand on Madison Avenue, New York for. Your brand is your promise. And if you're able to convey that to your investors when you're networking, you will start a very prosperous career in real estate.
Love it.
I did it without choking.
Thank you so much for your time. And for the listeners at home that want to find you,
they can go to investinglegacy.com and download a free Audible code of me narrating my own book without costs, of course. You can do that. It's available for your listeners, Danny. They can go to investinglegacy.com. And the other book I talked about too is called makingtheyield.com too as well. But I do appreciate this, and they can get in contact with me that way. If they do go to investinglegacy.com, they will be onboarded onto our multifamily office so they can see sort of behind the scenes, the deals we do, how we present them to investors. So we sort of open the kimono a bit to those people, and you'll actually see what we're looking at and why we make the decisions we do. We believe in having a very interactive family office structure with our investors because interactivity to us is the new currency.
That's amazing. And all of that will be in the description below. So if you didn't write that down, you can catch those 2 books and Sal's contact down below. Sal, thank you so much for your time.
Thank you, my friend. Danny, have a great one. Thank you, my friend.
All right, man. Take care.